analyzing and recording transactions. So again, we're gonna use accounting equations for recording transactions. Now, basically, for any of those transactions, it should affect, right, at least one of those accounts, and still need to keep the accounting equation balanced for each transaction. Right, for example, I paid $10 for a tool. Right, I paid $10, I reduce my asset, but I get the tool, increase my supplies. So the asset accounted is affected twice, decreased by paying asset, increased by acquiring the tool. Accounting equation is balanced. So this is the basic way how we analyze and recording transactions. And we're going to follow this for the rest of the lecture. So this is an expanded equation for the basic accounting equation, right? Assets equals liabilities plus stockholders' equity, right? Revenue minus expenses equals net income. It's expanded version. The idea will be the same. So, what is an account? Account is a place to record an increase or decrease of assets, liabilities, equities, revenue, or expenses. And a list of all accounts titles and their identification codes is known as the chart of accounts. For each company, there will be a chart of accounts listing all the accounts the company has. Right? So each transaction is going to affect two accounts. At least two accounts can affect more than two accounts. So let's see those transactions. So on May 1st, investors contributed $10,000 cash. Okay, and so the investors get 500 shares of stock. So for the company, when we receive $10,000 cash, right, assets will increase by $10,000. So on these left side equations, asset increase. To make these accounting equation balance, either liability or stockholders' equity will increase. And here, for sure, the contributed capital, the equity, will increase by $10,000. So we have an increase on both sides. The accounting equation is unbalanced. So let me finish this journal entry, but we're going to talk about that later. Okay? So if we have increase in cash $10,000, I debit this account $10,000. Right? So cash, you can also say cash increased by $10,000. So we're going to learn debit and credit rules real soon. And on the other hand, my stockholders' equity will increase by $10,000 as well. Right? To be more specific, that's contributed capital. Okay? And to be more specific, I have two accounts to record a $10,000 increase in equity. One is a common stock account. Common stock account is going to record par value of the 500 stocks issued. For example, if the par value is $1 for each stock, then the total par value from the stock issuance will be $500. Okay? and the remaining amount is called additional paid-in capital account. It's going to record the remaining part of increase in equity from the stock issuance. That's $9,500. All right. If I remove this part, and this become a completed journal entry. So in this journal entry, we debit cash 10,000, credit common stock 500, and credit additional paid-in capital $9,500. Right, next, the company borrowed $4,000 cash by signing a note to be repaid. If we borrow money, we get $4,000 cash, so assets increase by $4,000. And on the right-hand side, now this time the liability will increase by $4,000. Okay, accounting equation is still balanced. And the journal entry is very straightforward, right? We're going to debit cash, $4,000. And we have credit liabilities. This is a short-term loan. Right? Because it will be paid in a month. Loan will increase by $4,000. Complete journal entry. The company signed a rental agreement for a store locations and paid $1,800 security deposit. Now this time we paid $1,800, so cash decreased. On the other hand, right, we prepaid. It's a security deposit, prepaid rent, $1,800. As I said, prepaid rent is an asset. Increased by $1,800. Right, in terms of journal entries, I'm going to debit the prepaid rent. This increase in asset. Then I'm going to reduce my cash, so I credit cash. Right, that's going to we finish this journal entry. Then lastly, the company purchased 2,000 inventory on account. When we purchase inventory on account, we're going to pay vendor later. So inventory will increase by 2,000. At the same time, liability, right? Account payables will increase by $2,000. So in the journal entry, we're going to debit the inventory. That's $2,000. Then we're going to credit liability, account payable, $2,000. Right? So by the end of the day, when we update all the accounts with their ending balance, okay, assets, liability, equities, or accounts updated with ending balance, the total assets will equal the total liability plus the equities. Right, so how do we have income statement? Income statement report the result of operations for a period of time. During the last year, we have revenues, right, and we have expenses. The difference is net income or net loss if it's a deficit number. But we have the revenues first subtract cost of goods sold equals gross profit less any other expenses. Operating expenses equals net income. And here we have the example of target income statement. Right, so revenues less cost of sale or cost of goods sold, it's the same thing, equals gross profit. The gross profit is first subtotal. Then we have the subtract the operating expenses plus other income or less any other expenses equals income from continuing operations before income taxes. So operating expenses are usually incurred to support the main business activities. We call operating expenses. If it's not main operations, not main business, that's other income or other expenses. All right. So we have the next subtotals, income from continuing operations before income tax. Then we're going to calculate the income tax expenses, subtract income tax expenses equals the net income or net loss. For sure, this is net income. Right, we know revenue less expenses equals the net income. Okay. So these are the operating revenues and expenses. But sometimes we have non-operating revenues and expenses. So they are related to companies' financing and investing activities. For example, we have interest revenues, interest expenses. Okay. So make sure we separate the recurring and non-recurring items because they're going to have different insight into company's future performance. Recurring items, recurring revenues, non-operating revenues, expenses, they're going to persist in the future. For example, right, interest expenses will be recurring, so for sure it's recurring items. It's going to persist in the future. So in the future, we can also have interest expenses. So that should be considered for future performance. Sometimes we have non-recurring items. So those are the items that has no future implications. For example, it's just a one-time inventory write-down or a loss due to strike. Okay, those are non-recurring items. So they should be treated differently from recurring items. Accrual accounting is a very important concept. It's required by both US GAAP and International Accounting Standards. So what are accrual accounting? Accrual accounting deals with time difference between the cash and revenue expense recognition. Revenues. We're going to recognize revenues when company has fulfilled their services or provided goods. So when I provide service, finished work for my customers, or have shipped inventories to customers, I need to record my revenues, regardless whether I have been paid or not. I have my revenues recognized. Okay? So when my customers haven't paid me yet, I need to accrue those revenues. At the same time, recognize accounts receivable. The same thing for expenses. Okay? When I've consumed or paid when I consumed, like I used borrowed money, right? But I haven't paid interest yet, right? The expense is incurred already. So I need to recognize the interest expense. At the same time, recognize interest payable as a liabilities. So in this case, I accrued an expense, regardless whether I have paid or not. So let's see some examples of accrual accounting. First, accrual accounting revenues. So the company purchased inventory for $80,000. and the sales half during May for 140,000 cash, how much revenue will the company recognize during May? So we have sell 140,000 inventory, right? That is our revenues, regardless whether we have received payment or not. The revenue will be recognized for $140,000. And I said, regardless whether they have been paid. Example 1 is totally paid. Example 2, partially paid. Doesn't matter. Regardless whether they have been paid or not, the revenue will be recorded $140,000. Now on the expense side, right? The company purchased inventory during May for $80,000. It sold $70,000 in inventory for $120,000. How much cost of goods sold should the company recognize? Right? In here, the cost of goods sold will be the $70,000, the cost of inventory sold. Okay? Again, regardless whether I have paid those inventory or not, doesn't matter. As we mentioned, financial statement linked, and we call those linkage articulations. The return earning is a very important tool to link net income and the balance sheet. Okay, we have the return earnings right from the previous ending balance of the previous balance sheet. Then we're going to add a net income from the current income statement. Okay. And we're going to record other changes in our equities, returning other comprehensive income, dividend declared, repurchase stock, stock option award, and we're going to have the ending return earnings. And this will be reported in the new balance sheet. So this is how these financial statements are all linked.